Hey guys, welcome back to the video. Today I got five undervalued stocks for you that I'm gobbling up this month in December 25. So let's hop right into it with Zeta here. And first thing I wanted to talk about was their Q3 earnings. I mean, this company has been on an absolute tear and it's just not getting the credit that quite frankly they deserve. I mean, another beautiful Q3 2025 revenue growth 26%. Cash flow from operations, right? This is a free cash flow measure, 68% growth. Adjusted EBITDA year-over-year growth, 46%. I mean, they're growing revenue and EBITDA 26% and 46% a year. I mean, even look at it from a margin and growth perspective for a rule of 40. We have 26% growth and 23% EBITDA margin. That's giving us what, a 49, just about 50% rule of 40. I mean, this company is growing fast. Not many companies in this space have this rule of 40, and it is not valued appropriately. I mean, there's a lot of alpha here for you guys. This isn't some, one-off quarter, 1-year thing. This company has been consistently delivering these results. I mean, I can't think of too many companies delivering results like this. I mean, look at this chart. 15 straight quarters of 20+% revenue growth. That's absolutely ridiculous. But the even more ridiculous statement is the following: 19 consecutive quarters of expanding adjusted EBITDA margins year over year. I mean, it's one thing to be able to grow your product and see the demand and get that 20% growth rate for 15 quarters, okay? Just about 4 years straight. They're growing at 20%. But to actually realize that and have a profit, I mean, this is a proven business model that's only just going to keep accelerating. You guys need to get in on the ground floor here. And once they secure a customer, they just keep spending more and more money because the company sees so much benefit from Zeta, right? Take a look at this graph here. The longer our customers stay with us, the bigger they become. And they demonstrate it here. Let's just look at the 2Q 2025 trailing 12 months. Customers that have been spending less than a year, so a newly onboarded customer, typically drop $600,000 on their services. Now, fast forward to, when they've been with the company for 1 to 3 years, they're spending $1.5 million. That's almost a 3x in spending that you're getting from it, and it just keeps gradually increasing, right? Take a look at the 3 to 5-year bucket. Now we're at 2.1 million. That's a 50% increase. Each year someone stays longer with Zeta, they keep dropping more and more money to the point where they get another 3.2 million for people that are staying there for 5 years. That's another 50. It's more than 50% increase. I mean, 90% of the revenue driven by scaled customers who've been with Zeta longer than a year. This is what you want to see. People are infatuated with this product. Company has zero plans of slowing down. I mean, the companies keep accelerating forward. I mean, look at some of their 2028 goals for Zeta. They want a $2.1 billion revenue target, which implies a 20% compounded annually growth rate. So they're going to be growing by 20% from here to 2028. And if you look at the adjusted EBITDA target of 525 million, that's an implied 25% margin. So right here, management's telling you we're going to remain a rule of 45, still above that rule of 40 up until 2028. And the market is not giving that premium. I mean, rule of 40 companies, they command a premium at least a little bit over 30 times earnings. And I mean, the stock is so cheap right now. And if you look at free cash flow, right, this is, in my eyes, the hardest and the most important, right? If you have no cash flow, your business is drained. You either need to dilute or you need to add debt. So the fact that they're have positive free cash flow or targeting a 65% conversion from EBITDA to free cash flow is very, very healthy. It would represent 16% margins. Very nice free cash flow. And this is what I mean by, it not commanding this growth multiple. I mean, this company has time and time again proved that we're exceeding 20% growth. We're projecting EBITDA margins in the 25% realm. And I mean, they're only getting credit for a 20 times price to earnings multiple. I mean, this is cheap, guys. Cheap, cheap, cheap. All right, so the next stock I have for you guys is Uber, and some of the stuff you'll see, especially from a valuation metrics perspective, is like shocking, eye-popping how cheap this is right now, right? And I mean, especially considering some of the tailwinds in AV and how we've seen them perform in Black Friday. I mean, Black Friday, Uber grew 300% year over year compared to last Black Friday. They have tons of new partners, Best Buy, Home Depot, Petco, Sephora, they keep really building out this delivery system. And I mean, they just rolled out AvRide, which is partnership with Nebius. I don't know how to pronounce that name, ticker NBIS, and it's officially launched its commercial robotaxi service in Dallas, and they're partnered with Uber. So I mean, this company has a lot of tailwinds moving for it. It's free cash flow positive. Their revenue's up. Their bookings are up. But we'll all hop into that right now. The first thing I just wanted to point out is that Uber is leagues, head and shoulders above the competition. I mean, you can look at it with DoorDash, you can look at it with Lyft, you can look at it with Grab. I mean, they dominate. Especially if you're looking, don't look at the percentage growth, in my opinion, between the competitors if you're going to go and do an analysis, because Uber is so much larger that the law of large numbers here, when you're working with this much volume, is going to make it look like Uber is growing less on a percentage basis. But if you actually get in that nominal growth, Uber is adding a DoorDash and a Lyft like every corner. That's how big they are. Okay. And I mean, they just eat their whole entire lunch. I mean, Uber is the undisputed leader in this category. This execution is a thing of beauty here. I mean, look at the free cash flow margins for the longest time. I remember Uber was not profitable, and people, the idea was great, but it was not profitable. And I mean, look at the corner they've turned on the hardest profitability metric, free cash flow, bringing it all the way up to 16% and increasing. I mean, the stock is very, very well managed company. Okay. The gross bookings, if you take a look at it, I mean, the 5 year growth rate is averaging 23%, although growing has slowed because again we're getting to that law of large numbers, more towards 18% in the last 2 years and 15% in the 1 year. But I mean, the company continues to expand significantly, and their monthly active customers is up. And again, they took a little dip here in Q1 here, but I mean, look at the rise. This company is growing their platform users by 10% a year. I mean, these fundamentals are very, very strong for a company of this size. And the company is blows out of the water the rule of 40. And it's like, oh my gosh, you could take these are two of the lowest here, right? 19 and 33 is 52 on a rule of 40. But look at some of these others, right? It was 22%, 21, 17, 18, 19, EBITDA margins 53, 44, 35, 35, 33. I mean, this company has strong revenue growth, strong profitability from EBITDA, from net income, from free cash flow. I mean, this company is rolling and firing on all cylinders. This stock right now, based on the PEG ratio, right, it takes into consideration the growth, is at its cheapest. As cheapest I could find going back. I just cut it off after 23, but I mean, just take a look at this graph. It was trading at 4 times, 6 times. Its current PEG ratio is below 1. It's at a half. I mean, this thing is so cheap for such a big company with these industry tailwinds. I mean, it's a buy right now. The next stock on my list is MercadoLibre, ticker MELI. And this company again is another very, very strong, growing fundamental company. I mean, take a look at this chart. They've achieved more than 20 consecutive quarters of being able to grow their revenue by more than 30% year over year. In the last 5 years, revenue's growing at a CAGR of 48%, while the stock only increased an average of 6% CAGR a year, right? I mean, this revenue will continue to grow by more than 30% annually in the next 3 years, and its earnings per share also by 30%. I mean, this stock is beat up and not getting the credit it deserves for how impressive its growth and revenue and earnings are. I mean, these are three very, very telling and powerful metrics to analyze a company very quickly. I mean, look at their revenue growth, never slowing down year over year, right? Like constant growth. And take a look at the return on invested capital. I mean, it is so, I would never invest in a company that wasn't doing 15% plus in return on invested capital. I mean, it's a must. It tells you how good of an allocator of capital management is. And that is so important to the breadth and everyday life of the business. And I mean, look at that. We're talking about uh, s- above 50% return on invested capital. That's bizarre. That's insane. And then look at their rule of 40, which is the orange line, just about at the same spot, well over 50%. I mean, this company is not getting the credit they deserve, in my opinion. And when I say they're not getting the credit they deserve, I'm talking about look at the forward PE ratio. I mean, this company has been hovering around 47 times price to earnings because it commands that 30% growth year over year for 19 quarters and expecting it still to continue well into the future. But look at this nice little dive. Nothing, the company has only gotten stronger. And this is a nice little entry point to hop into Mercado Libre. And this isn't to mention the tailwinds hitting this industry. I mean, they're going to be completely robotized. They're going to have robots everywhere, just like Amazon sorting the packages, delivering the packages, organizing it. I mean, they are going to save so much money on costs that their margins are just going to continue to expand. All right, the next stock on my list is Adobe, and I'm a firm believer Adobe's not going anywhere. Go ahead, disrupt the technology all you want. I think it's really going to be a tailwind and not a headwind for Adobe. But I mean, knowing that the enterprises and businesses that use this, these people are dinosaurs. They don't want to switch anything ever. We have a process and it works. They're not getting rid of Adobe. I promise you that. Okay. And look at the fundamentals. I mean, look at the share count. They decreased the share count with buybacks by 2% a year. Their free cash flow margin. I mean, look at this. On the 5 years, it's grown 16%. On the 2 years here, it's grown 15% in the last year, and it's grown 33%. I mean, this isn't a dying company. 90 plus percent of the recurring revenue is all subscription based. They're not going anywhere. And I mean, look at the total revenue changing and growing by 18% a year for the last 11 years. I mean, this is a beautiful time to get in on this company. And any way you want to cut it, the thing is undervalued. I mean, you can see by this chart, in gray's the revenue and in yellow's the stock price. And there's definitely a correlation. You could see how tight the stock price rides the revenue growth line. And you see what happened when it separated sometime in 21 and 22, right? It went from a low of 2.4 billion to 4.8 billion. It looks like we're getting the same exact dip for an entry again. I mean, it looks like a great time to buy the stock. If you don't believe in the revenue, okay, let's look at enterprise value to operating cash flow or enterprise value to EBITDA and chart it from 2016 to 2025. This thing's been trading at 24 times and 21 times, and now it's at 16 and a half and 12 times. Guys, this stock is cheap. And it's not just me who thinks this stock's cheap. I mean, take a look at all the analysts covering this stock and keep in mind that Adobe at this time was trading at $322. Look at these price targets: 390, 500, 420, 450, 400, 370, 500, 420, 450. I mean, everyone on Wall Street is agreeing with me and saying this thing is undervalued right now. All right, the next stock on my list here is Amazon, and honestly, this is probably the best risk reward play in the market right now. I mean, this company's been growing their revenue 5 years at 15%, 2 years at 12%, and the last year there at just about 14%. I mean, take a look at the ecosystem. Take a look at what Amazon owns. I mean, it's like half the internet they own. Prime, AWS, Twitch, Whole Foods, Ring, Audible, Kindle, Alexa. The list doesn't end. Yet somehow Amazon's barely up year to date, while the S&P 500 has left it in the dust with all of the same tailwinds that I was describing in MercadoLibre, with all of the robotics being able to come in and slash expenses and make profitability skyrocket. I mean, just let your imagination run wild from my last point here on the robotics tailwind. I mean, take a look. These are all Amazon robots. I mean, the floors are plagued with these robots. They're doing deliveries in these little kind of the serve robotics, honestly. It's like a direct competitor now. And take a look at the robots manning and organizing. I mean, imagine where this thing's going to be in 10 years. There's going to be human oversight, and that's it. They're not going to be humans on the floor anymore. The margins are going to increase. I mean, it's going to be something else. And just to really drill home the point here on Amazon being cheap, I mean, this is this is now the largest revenue generating company in the United States. Everybody knows it. It has industry tailwinds, and look at the multiple over time. I mean, we're looking at enterprise value to EBITDA. I mean, from 21 to 25, the median value is 21 and a half, and it's only trading at 17 times to, Warren Buffett loves to say he wants to buy a wonderful company at a fair price more than buying a fair company at a wonderful price. And this is the prime time example of that. That's all I had for you guys. Hopefully, you got something out of it. Let me know in the comments if you'd buy or sell. And as always, do your own research. I'll see you in the next video.